of Cyprus Natural Hydrocarbons Company and also Senior Fellow at the Atlantic Council. Thank you very much, gentlemen, for joining us. Richard, perhaps I could go to you first, and let's talk about the headlines, headline of the week, really, the last couple of weeks, which is the Russia-Ukraine tension, let's say, build up. We've seen a little bit of retraction overnight, it seems, perhaps not surprisingly, but how much of an impact has this build up had on oil markets?
I think it's a question. I think we've all seen what the price has done. We've seen the rally, and I guess the question is it a function of what was coming out of the Ukraine? From the take here in the States and listening to the kind of the media stories of this weekend, it took on a sense of I don't want to say almost a political. Was it being done for political reasons? Nancy Pelosi, who's the Democratic majority leader of the House, was on and really almost my show called Meet the Press and kind of spilled the beans, saying, you know, we're going to issue sanctions because if we issue sanctions, then they will not invade. And it's kind of a way to win if you win no matter what happens. It's to say we did something when they didn't really do anything and have this kind of win. My take on all this is I never thought that there would be a war. It didn't seem to make any sense, and there was no reason for them to invade. And I think we're probably seeing cooler heads prevail. The real question is how much of this recent price rise was a function of what we just are coming out of. And I could say maybe it's $2 or $3, maybe $4.
Right.
We've seen this before, right? We've seen war talk before, and we've seen markets react. And I guess that's one of the big questions that we have to ask ourselves. Is this different than historical plays?
And I mean, I suppose, as you're right, I mean, there's been a lot of sort of skepticism on why the US in particular and Europe has followed suit and sort of building up the rhetoric of, oh, something's going to happen. And meanwhile, Putin is moving physically, but he's been saying, well, I'm not going to invade. So what are you all talking about? And as you said, we've got a price chart there, I think, Richard, that you've given us.
This is something interesting. I mean, I happen to have been around for decades, that's, not to date myself, but I was on Wall Street running a large energy futures desk during the first Gulf War. And there was a very, very important thing. You can find it on YouTube. It's called the Regrettably Speech. And when James Baker comes out after talking to Tariq Aziz, and he says in the words, regrettably. And literally at that moment, the market rallied $9. It had already gone up from $10 to $40, and it was on its way back down, trading $20. And he said the word regrettably, and the market rallied $10. It proceeded to rally another $5 or $6 for the next few weeks. The war started and the market collapsed. The market had already priced in the news. And then we can fast forward to the next war, when the day the war started, they invaded, within short order, the market had fallen almost half the price. It had gone up and proceeded to go back and retrace its entire move. This time, the question is it different? And I think from a political perspective here in the States, everyone didn't like Trump, and everyone talked about Trump was this and Trump was that. I don't know if you appreciate what Biden is doing and some of the failings and some of the unpopularity here in the States right now. And so I think a lot of us have seen this as really a way for him to show his credentials and show how tough he is. But does that really matter? I guess that's the question. If this just goes away and the tanks pull away, what's going to happen to the price, and does that matter? In fact, is it the other factors that are the driver right now?
Thanks, Richard. Well, let's talk about that. Ahmed, I'll go to you. What are the other factors? And it certainly seems, undoubtedly, there's no one questioning how tight fundamental supply has been for the last few months, as we see demand recovering globally, demand for energy. So how much of the recent sort of price support the last month, we've seen new fresh 7-year, 8-year highs being hit. How ominous is the tight supply situation, given OPEC's spare capacity problems at the moment.
Yeah, good morning, Diala and others. There's a lot of factors to look at. So I think, firstly, important to say this is a backwardated market. So actually, even though we're not on the futures at 100, actually in physical markets, technically, almost there. Basically, dated Brent actually reached almost 98, I think, on earlier in February. And that's actually a signal of, when you look at the balances as well, the function of what's happening. And I think that, naturally on previous shows, you've talked about OPEC spare capacity, you've talked about inventories, the IEA demand revisions. Fundamentally, I think what's an interesting corner of the market is actually in the middle distillates. And actually, this is, what I call the revenge of the middle distillates. Because across every major product region, storage region, you've seen the key storage areas. You've seen effectively big draws. Singapore distillate inventories are down. Asia, because of the reduced exports from China on products, you've seen also refining margins go up. In Europe, the gas oil deficit is already quite steep, and it's going to widen even further because you've got maintenance season, and then you've also got the high cost of gas, and also you've got the cost of carbon as well going up, and it reached a record recently. So that all means that refinery runs in Europe, for example, are being slightly disincentivized, and so that means that effectively these product prices are going to have to go higher to pull in barrels from other parts of the world. So it's not just a sentiment-driven rally from the Ukraine crisis, and in any case, the gyrations in the price from will they, won't they, U.S. telegraphing intentions, these are not the this is not the key driver. It is driven by what's happening in the physical market as well, and also you can see that in other pockets and corners, just every clue out there, whether it's the price of how certain grades with a high gas oil content are trading, in Asia, a lot of the benchmarks are showing a lot of premium. I mean, just in Asia now, for example, some Russian grades are out for tender as well, and they're expected to fetch very healthy premiums to benchmark. So,
okay,
and so to answer your question,
let me just go back to you on this tight scenario you're describing on the products market, but also obviously that also filters through to crude as well, and on the pricing side. So, can OPEC do anything about this? I mean, are we going to see them? Can they change their volumes at the next round? I mean, everyone now is talking about Saudi not being able to do anything. Forget the other.
So I mean, as you know, and I'm sure it's been discussed ad nauseum, the gap between OPEC plus output and the target levels. That's been what is it, 800, 900 KBD, difference, and actually that will probably get worse because you've got Kazakhstan having maintenance next quarter. You've also got the so really actually, and even actually amongst those countries, Saudi and UAE are really, the only ones. Even Iraq, for example. There are issues around they can add about an additional 200 to 300 KBD to the exports itself, but that will worsen. That OPEC plus deficit is actually going to get wider.
Yeah, well, it's going to get wider, and yet, hello, Dr. Charles. Good morning again.
Good morning.
We're talking about OPEC, and it's going to get wider. But come April, May, we've got a few of those countries in the group whose baselines are going to be adjusted, and more is expected to come out of them. I mean, Dr. Charles, just give us a bit of where we are. What's your perspective on the tightness in this market, and from a capex point of view, this argument that it's done too little, too late in terms of people, continuing to invest in oil and gas, and here we are. Is that changing? Is this situation going to change that scenario of how much investment is going into conventionals?
Well, it seems to be changing the situation in the United States. There are more noises coming out of more investments in shale. EIA is projecting increases in production from shale, and ExxonMobil, Chevron are planning to increase production from the Permian. So all of that, I think, is going to help. But something that quietly happened during this week is the Iranian nuclear talks. It seems that there is some optimism there. It seems that some small developments have happened. I mean, for example, the United States restored some sanction waivers last Friday, and that has given some impetus to the whole thing. And one wonders if, given the problems Biden is meeting with the cost of petrol in the United States, whether he will be now more eager to seize the opportunity and go for a settlement here to bring up production and prices down. I mean, that's a possibility.
Yeah, I see Richard there nodding his head. As you said, Richard, I mean, it's all a domestic agenda, right? He's been desperate, if you like, to get
Dr. Shaw, I think Dr. Ellis that's an excellent point you just made, Doctor.
But Richard, does it make a difference whether we reach a deal with Iran? Because we're seeing the oil filter through to the market anyway from them, aren't we? I mean, what difference will a deal make in that analysis? And how hopeful are you that we'll get something official on paper by the summer with Iran?
I think that the doctor's analysis is spot on. I think that's a subtle term I have not heard someone say yet. And I think, and I had not really thought of it. I thought of it and I had not verbalized it. He just did. And I think that's exactly right. When policies about nuclear policies about a nation that you consider to be a terrorist state are determined by the price of gasoline so you can get votes in the midterm election, that shows you the state of the U.S. policy. You can't even make that up. You can't, that statement I just made, you can't even, that is something which they used the 50 million barrels of SPR release a few months ago. That was, you didn't see it, but it was touted on the news everywhere that they lowered the price of gasoline by 7 cents. Now that was all of 3 days of crude supply for the United States, but the people in the United States are not really focused on that. They don't think of things that way.
Yeah, they just. Are you hopeful that that we'll see the sort of uptick in shale, if you like, re-drilling of wells make a real difference into this market?
Well, again, the doctor made a very good point about that, and I just saw a fascinating chart. DUCs, the wells to be completed, has dropped by 62% in the last year. It's going to drop by 50% more in the next 6 months, and I think by the middle of 23, it's going to be down at a very low level. So we are going to see the Permian reach all-time highs here pretty soon. And again, Chevron, the large players. What we've done though is we've changed the mix. Where everybody else had, with the MLPs and the private equity was chasing every well, every moment. Now it's moved into the hand of the Exxons, the Chevrons, and the Occidentals. Well, not the Occidentals, excuse me, the Chevrons. And they built pipelines to the refineries. And they're not going to chase the dollar. They're going to chase the refinery yield. As Ahmed said, that's exactly right. They're going to chase margins more so than price.
Okay,
but then talk later about that.
And they've also made a lot of money in the last few months, in the last year. Those IOCs have, obviously incredible cash flow and profits coming in last year, and it'll be interesting to see where they put that expenditure to. Ahmed, just to go to you a bit, and you mentioned Iraq. I'd like to just go there in terms of, you were saying actually they could add a bit of oil. But some news also emerging, I believe, this week on the KRG area, oil sector, and what's the update on that, and how is that going to impact the country's ability to improve on its exports?
Yeah, it's an interesting development, which actually is slightly more symptomatic of the ongoing government formation process and the challenges associated there. So, just for context, yesterday, basically the Supreme Court in the country ruled that the KRG effectively, its whole oil sector is unconstitutional and that it should all be passed to the federal government. And, you know, that has implications. I mean, effectively in the reading was around unconstitutionality of IOC contracts, trading houses. You know, there's about 4 or 5 big players like Rosneft, Vitol, Glencore, who have prepayment deals with the KRG on their crude, saying that this is also not constitutional or what have you. So a big list. But I mean, the backdrop effectively is that there is, as you know, there's a alliance going on for the new government between Muqtada Sadr and the KDP leader Barzani. And really, this is an attempt to poke Barzani in the eye because the federal court has links with other Shia parties who are not happy with that alliance. So I don't want to go into too much detail on that for listeners, but effectively the backdrop is that does it have, I mean, what does it mean for the IOCs and the trading houses? Firstly, I think that, you know, these contracts are enshrined, you know, with international arbitration courts. So, you know, so it'd be very difficult. And actually, in any case, if Sadr does get his way, you know, they could appoint a new judges effectively. So it's still something to watch, but it's symptomatic. It's symptomatic, I think, in a way of the breakdown in federalism in the country, and even these pending mega deals like the Total deal. You know, they are also now under pressure. So certainly the outlook for the country is highly volatile. But just as importantly, this is at a time when the call on Iraqi crude is very strong right now, and that's being shown from even the spot tenders that SOMA are launching in the market. You know, so you know, Iraq is definitely a country to watch.
Well, I mean, and I'd like to get on and talk a little bit about demand as well and where we're going with that. But Dr. Charles, just to go to you just one more time on the supply issue. In terms of the Russia-Ukraine conflict, I mean, there's been, now seems to be diffusing, but if we were to have some real disruption or actual invasion or things escalate again, you know, how worried should Europe be about Russian energy supplies continuing to flow? A lot of people have said, well, they will continue to flow. Europe simply can't afford not to have Russian gas. Where would the continent, do you think, stand on that front, and what would it do to prices?
I think Europe should be highly worried. I mean, there are also some other developments that we haven't talked about, which happened last week at the opening of the Winter Olympics. Putin and Xi met in Beijing, and you probably heard of the 5,000-word statement they issued. It's an amazing statement. They said basically that there is a trend has emerged towards redistribution of power in the world, towards Russia and China, and away from the US.
They don't need to tell us that, I think.
And that the friendship between the two countries has no limits. In addition to that, this I believe is going to lead to it's going to impact energy flows worldwide, because one of the things I agreed there and then was a new pipeline out of the blue, a pipeline to bring gas from Sakhalin to Russia, about 10 BCM per year. And they also told us that they're in advanced negotiations to build Power of Siberia 2. So in a matter of less than 10 years, Russia will be exporting 100 BCM per year of gas to China. And I believe that is going to impact Europe. Europe is no longer, Russia is no longer going to be dependent just on Europe, so it can play one against the other. I'm not so sure it will play China, but it will. I think this agreement, this geopolitical shift, of which the Ukraine problem was just a facet of it. It is not at the center of it. It's part of the whole process. It's going to cause substantial realignment in energy flows, I believe. And not just energy flows, but probably also minerals. This link between Russia and China, which now has become very deep, based on the statement, it will impact Europe. I think Europe needs to look very carefully at energy flows, but also mineral flows from Russia to Europe.
Richard, let's just go back to the US and talk about the economy there and demand. What is that? Where would all settle if Ukraine crisis is resolved? Closer to, okay, there you go. Well, let's answer that question first, then get on to demand. Where would it settle at? So you've got those 90, 85, 80. We're obviously above that right now, but will it settle down to which level? So everybody can put in their answers there, and we'll go to that later. In terms of U.S. economy, demand, again, I mean, you've got obviously the whole Fed monetary policy, the Fed, the rate rises planned for March. Some people are talking about 2 rises in March, etc. How delicate is that policy, do you think, being viewed in terms of not going too far and not rocking the boat with the economic recovery that we've seen? Obviously, we've got, the economy is booming, you could argue. So how is the Fed going to sort of approach that very delicate balance of not sort of destroying demand, if you like?
Sitting from my office here, that what the Fed does, I think they will determine. But I think the Fed, whatever they do, whatever the market corrects, they'll stop whatever they were doing and go back to either a flat policy or easing again. I think there is no out for the Fed. You cannot take interest rates to 5% because you'll bankrupt the United States, and so I don't think that's going to happen. But what Dr. Charles said again, I think was interesting. This is not Mao and Brezhnev. These are 2 new players. And simultaneously to what is going on in the U.S. with knowing the debt levels we have, simultaneous to that is the U.S. has taken I'll call it maybe a bow and arrow because guns are bad, to their heads and said, we're going to now become green. And we are not going to, we're taking green policies. And Europe is trapped. They've closed half their coal plants. They're going to close they closed nuclear plants during the winter. Now, whoever thought that one up, I'm not sure, but that is, beyond crazy. And I don't know if I said this in a talk maybe a while ago. In the U.S., as they fight over policy, the senators from the northeastern states are demanding that LNG is not exported from the United States because they need natural gas. But the ex-governor of New York had prevented pipelines from the Marcellus to flow into Massachusetts. So the governors who don't want the LNG to be imported into their states in Boston prevented a pipeline being built from the largest field in the United States to their state. And so what we have here is cognitive dissonance. I'm not sure what the exact term is, but it is. I think Xi and Putin see it. They're smart enough men. They're gonna, if your counterparties are making mistakes, don't interrupt them. Just let them go along. Let them be green. Let them do whatever they want to do because it's going to work to their advantage in spades.
Ahmed, just to go to you a bit on again talking about demand and where we're going. I mean, we're seeing prices today in the up in the top sort of 90s. At what level do you think we will begin to see demand destruction? What would it take to trigger the world into sort of, obviously the solution for higher prices? So, would it be $100? Would it be 110? What is that threshold that will make a difference to the direction that the global economy is recovering in?
Yeah, I think. I mean, clearly there's more to this rally. I mean, the question you put up earlier, I think, is not the correct one in a way, because in a way it's not the Ukraine crisis driving this rally. It's been going on since, December. I mean, that the escalation issue around that, I mean, if you do see that escalation, of course, that's going to tip everything over and move us into 100+ territory. But the issue is around I think that, the slower consumption growth, certainly from high oil prices, that would, in terms of actually a slowdown in the business cycle, but also, as Richard mentioned, the impact of high interest rates. I think also China as well is going to be an interesting story to watch, because if you suddenly get, what will Chinese policy look like around, higher oil prices? Already, you've got a very politically sensitive moment around around their policy on decarbonization, but also in terms of ambitions to add more capacity this year, stockpiling mode at the moment. So that certainly the demand drivers are there, but I think that the emerging market story as well, in terms of how governments react to policy on subsidies and fuel price hikes, particularly diesel, is also going to be one which stokes some turbulence as well.
Richard, on the China question, a lot of forecasts now that the growth that we saw this in 2021 in China is the new norm, 5% ish. And that's going to be the case going forward. We're not, although it's the markets have relied on it as one of the biggest consumers, we're not going to see China providing the same sort of pull on energy as it used to, because its GDP is going to adjust to a new level. What are your thoughts on that? In terms of, would you agree with that, or was this just a temporary blip in Chinese growth because of its restructuring of its economy?
In economic theory, energy GDP ratios always are falling. So no matter what your GDP is doing, your energy GDP ratio is, as far as consumption is, continuing to fall, and that will continue to fall for them. I think this issue that we're talking about now, we tend to look in the short term. I think our problems are late 2022, 23 and beyond, into 24, 25, 26, maybe not even 26. Maybe we don't get to there at that point, but I think 23. When demand hits 103 million barrels, I think price is very inelastic. We've seen $130, we've seen $120. So I think the China increase will be made up by Africa and more cars, in the States. So just economic activity. The real decline will come during some kind of worldwide recession. That's, to me, is where the decline comes from, not from anything but that. And I think that if demand is going to be 102, 103 million barrels, and the U.S. is not going to be the marginal producer, will a little bit in the Permian, but we're not seeing money being spent. The banks are saying, I will not lend to you to drill oil. I'll lend you to build a battery, a factory. And Dr. Charles made a very good point about that, which I appreciate his point, which is the amount of the mineral control, the amount of minerals they're going to control. And so, is the new cartel, a kind of a demand supply cartel between China and Russia, where they control some significant assets that theoretically make the world run.
But with Dr. Charles, we are seeing, though, lots of new investment into green and renewables, etc. But the European banks are, in particular, still funding gas. I mean, natural gas is still being viewed as obviously essential, as it is, not just as a transition fuel, perhaps even beyond that. Your views on that? Oil may be a naughty kid for bankers, but not gas.
No, because with the energy crisis in Europe, I think Europe has seen the light that maybe they have moved too fast with the Green Deal and the transition. So they have now brought in, or about to bring in, gas and the nuclear into the taxonomy, allowing the banks and everybody else to invest in gas, at least for the rest of this decade. But there is, though, another factor coming here: the pressure on the banks by activists, by climate change people, to stop investing. And if I look at some of the statistics that came out this week, the banks, the major banks, invested something $106 billion in 2020 in oil and gas, up from about 83 billion in 2019. But in 2021, that dropped down to 50 billion.
But that's a result of a lot of tightening, belt tightening last year, obviously reacting.
It's not just that. I think it's also the impact of this pressure on the banks to stop investing in the oil and gas project, which is bound to increase. There is increasing pressure on them to stop investing. And even though the oil companies now are awash with money, and maybe they will be awash with money at the end of this year, in the longer term, the banks going away from investing into oil and gas is going to start having an impact, at least for for long-term projects.
Okay, and so we'll continue to see prices buoyed at these levels, perhaps. There's the result of our poll to close off our session, $90. Okay, so people are, yeah, there you go, very bullish. And we actually have an interview coming up at 12 o'clock UAE time with one of the bankers here in the region who have a very bullish outlook on not just oil prices, but the GCC economies in general, GDP forecasts, and very bullish for oil and commodities going forward. So let's see where all that goes. But thank you very much, gentlemen. Dr. Charles Elinas, Richard Radolia, and Ahmed Mahdi, thank you very much, gentlemen, for joining me this morning, and have a great day ahead.
Thank you.
Thank you.